The Reserve Bank of India, which acts as our country's central bank, has just made a very important announcement. On June 6, 2025, the governor of the RBI, Mr. Sanjay Malhotra, revealed a significant decision made by the Monetary Policy Committee, or MPC. This committee is responsible for setting key interest rates that guide our entire economy. The announcement was a surprise to many experts and market watchers who were expecting a much smaller change. This decision shows that the RBI is taking strong steps to influence the country's financial direction and to make sure our economy continues to grow at a healthy pace. What exactly did they announce? The RBI decided to cut the repo rate, which is a very powerful tool it uses to manage money in the country. The cut was a substantial one, amounting to 50 basis points. In simpler terms, a basis point is 1/100th of a percentage point, so this means the rate was lowered by 0.5%. This is a bold move, larger than the cuts many economists had predicted. It signals the RBI's firm intention to make borrowing cheaper and encourage spending and investment across various sectors of the Indian economy. This latest reduction brings the repo rate down from 6% to a new low of 5.5%. This is not an isolated event, but part of a larger trend. If we look back to the beginning of the year, this is the second major cut. Including the previous reduction in February 2025, the RBI has now lowered the repo rate by a total of 100 basis points, or a full percentage point, in just a few months. This series of cuts demonstrates a clear strategy by the central bank to provide a strong push to economic activity and ensure that growth momentum is maintained. The person at the center of this significant announcement is RBI Governor Sanjay Malhotra. As the head of the central bank, his words carry immense weight and set the tone for the financial markets. When he announced the rate cut, he expressed confidence in the Indian economy's underlying strength. He highlighted that despite challenges and uncertainties in the global economic environment, India's economy is showing remarkable resilience and stability. His statement aimed to reassure investors and the public that the foundations of our economy are solid and present many opportunities for future growth. So, what is this repo rate that everyone is talking about? Put simply, the repo rate is the interest rate at which the Reserve Bank of India lends money to commercial banks. Think of the RBI as the main bank for all other banks in the country, like State Bank of India or HDFC Bank. When these commercial banks need funds for their short-term needs, they borrow from the RBI. The interest they pay on these loans is the repo rate. It is a crucial lever that the RBI uses to control the supply of money in the financial system. Why does this rate matter so much to you and me? The repo rate has a direct influence on the interest rates that commercial banks charge their own customers for loans. When the RBI lowers the repo rate, it becomes cheaper for banks to borrow money. In theory, banks are expected to pass on this benefit to their customers by lowering the interest rates on various loans. This includes home loans, car loans, and personal loans. Therefore, a cut in the repo rate is generally good news for anyone who plans to borrow money or already has a loan. The most visible effect of a lower repo rate is on your equated monthly installments, or EMIs. Your EMI is the fixed amount you pay back to the bank every month for your loan. When the interest rate on your loan goes down, the total interest you have to pay over the loan's duration decreases. This, in turn, leads to a smaller EMI payment each month. For example, a reduction in the interest rate on a 20-year home loan can save you a significant amount of money over the long run, freeing up more of your monthly budget for other expenses or savings. This is why the RBI's decision is so important for the common person. A 50 basis point cut is quite substantial and should prompt banks to reduce their lending rates. While banks may take some time to adjust their own rates, the direction is clear. Borrowers with loans linked to an external benchmark, like the repo rate itself, will see the benefits much faster. For those looking to buy a house or a new car, this rate cut makes borrowing more attractive and affordable, potentially boosting sales in the real estate and automobile industries. The RBI's decision to cut the repo rate was not made in a vacuum. It was based on a careful assessment of the Indian economy's performance. The latest data on our country's gross domestic product, or GDP, played a crucial role. GDP is a measure of the total value of all goods and services produced in the country, and its growth rate tells us how fast the economy is expanding. According to the numbers shared by the RBI, India's GDP grew at an impressive rate of 7.4% in the final quarter of the fiscal year 2024-25. This strong growth figure shows that the Indian economy is on a solid footing. However, the RBI also looks at the bigger picture. While the quarterly growth was high, the government's estimate for the full fiscal year's growth is a more moderate 6.5%. The RBI's rate cut is a proactive measure. It aims to ensure that the growth momentum seen in the last quarter does not fade away. By making it cheaper to borrow money, the central bank hopes to encourage businesses to invest in new projects and factories and inspire consumers to spend more. Governor Sanjay Malhotra himself painted a positive picture of the nation's economic landscape. He described the Indian economy as a beacon of strength, stability, and opportunity. This is particularly significant at a time when many other major economies around the world are facing slowdowns and volatility. His comments suggest that the rate cut is not a sign of panic, but rather a move made from a position of strength. It is designed to shield our economy from these global headwinds and to unlock its full potential for even faster growth in the coming months. Therefore, the logic behind the rate cut is twofold. First, it serves to support and sustain the existing growth. Second, it acts as a cushion against potential global economic problems. By lowering borrowing costs, the RBI wants to make sure that credit flows smoothly to all parts of the economy, from large corporations to small businesses and individual consumers. This helps create a positive cycle where more investment leads to more jobs, which in turn leads to more spending, further fueling economic expansion and prosperity for everyone. Along with the repo rate cut, the RBI's Monetary Policy Committee made another very important change. It shifted its monetary policy stance from accommodative to neutral. This might sound like a technical term, but it gives us a big clue about the RBI's future plans. An accommodative stance means the central bank is prepared to cut rates further to help the economy grow. By moving to a neutral stance, the RBI is now signaling that it might not be so quick to cut rates again in the near future. This change in stance is significant. It suggests that the RBI believes the recent series of rate cuts, totaling 100 basis points, is enough for now to support economic growth. The central bank will likely adopt a wait-and-watch approach. It will observe how these rate cuts impact inflation and growth over the next few months before deciding on its next move. The neutral stance gives the RBI flexibility. It means that depending on how the economy performs, the next change in the repo rate could be a cut, a hike, or no change at all. So, what can we expect next? For people with loans, the immediate future looks bright. Banks are expected to start lowering their interest rates in response to the RBI's move, which will lead to lower EMIs. This is especially true for those whose loans are directly linked to the repo rate. This period of lower interest rates is a golden opportunity for those planning to take out a new loan for a major purchase like a home or a vehicle. It makes big-ticket items more affordable and accessible to a larger number of people. In summary, the RBI's recent decision is a major development for the Indian economy. The bold 50 basis point cut in the repo rate to 5.5% is set to make loans cheaper and help maintain our strong GDP growth. However, the shift in policy stance to neutral indicates that the era of continuous rate cuts might be coming to an end. The central bank has provided a strong dose of support to the economy and will now carefully monitor the situation. For now, borrowers can enjoy the benefits of lower interest rates while the nation watches to see how this move shapes our economic journey ahead.